In order to understand where these Canadian cross-border income trusts have come from, we need to have a little bit of a history lesson. So the first thing I want to note is that we use the term cross-border income trust, or CBIT, and there's another term out there that is used to refer to the same vehicle, and that's FAIT, F-A-I-T, which stands for Foreign Asset Income Trust. CBITs and FAITs are the same thing. We prefer the CBIT title because we found that when speaking with our friends in the U.S. particularly, the concept of a foreign asset income trust is confusing, and so we've adopted the more jurisdictionally neutral moniker CBIT to describe these trusts. So here's the history lesson. Up until about 2006, there was a vibrant income trust market in Canada. The market cap was around $250 billion. And these vehicles were popular first because they provided a high yield to investors, combined with equity upside, and second because they avoided double taxation, that is the corporate level of taxation, so that investment income that flowed through these vehicles was only subject to the tax that the investor itself was, the investor him or herself was subject to. So in 2006, the Canadian government decided that the income trust sector was threatening the Canadian corporate tax base. And so the legislation was passed which effectively shut that sector down. And since the concern was erosion of the Canadian corporate tax base, these rules indicated that it was still permitted for non-Canadian business assets to be owned through Canadian income trusts. And it took the market quite a while to identify the appropriate non-Canadian assets. Richard Clark with Eagle Energy Trust in 2010 became the first CBIT, cross-border income trust, and a number of others have followed, and more are in the pipeline. These vehicles have a low risk from a Canadian tax perspective as well as from a U.S. perspective, because they are within the policy mandate of both the Canadian and the American governments. Now, from the perspective of an owner of U.S. business assets, the CBIT may be of interest because the yield-oriented investors in Canada may put a higher value on certain U.S. business assets than would otherwise be the case. In Canada, the attraction is still the same as it was before. There is a deferral or avoidance of the second level of tax, the corporate level of tax, and this depends upon the way the U.S. rules work. And then the result is a high yield investment in Canada, which has equity upside in a fashion very similar to the old income trusts. So with the demise of the income trusts, the old income trusts, there is a large demand for this type of yield-oriented investment in Canada. And this creates the opportunity to bring new vehicles to market, which is what the CBIT is doing. It's feeding a vibrant demand for yield in Canada.